Welcome back to Stock Market Weekly. I am your host, Evan Medeiros. This is the show where we cover the most notable moves across financial markets through the lens of technical analysis. We're publishing every Friday, so make sure you are subscribed to our YouTube channel. Hit those notifications so you never miss an episode, so you're always prepared for the week ahead. I'm off camera this week. I'm a little bit sluggish. I am rallying through with a strong cup of coffee right now. The 3-week-old has done a good job at tiring me out this week, and I think so have the markets, right? They are back to their corrective, sort of volatile back and forth state. And so off camera, but we're going to get through and we are going to talk about what moved this market. So front and center this week, tariffs. New 25% tariffs on all foreign-made cars and auto parts. That hit the tape earlier in the week. That was off kind of the radar of the market, and that certainly kind of refreshed the memory of the market of why we're correcting and why we're selling off here in the first place, because we were in rally mode until that news sort of hit, and then the markets proceeded to roll over. We also had PCE inflation data coming out a little bit hotter than expected later in the week. And then we also saw more sentiment survey data come through, which continues to be absolutely abysmal. People's expectations on the economy and markets are at bear market, historic, very low bottom 10 percentile of outlooks. And that continues to be the case now for the last few weeks in a row. And as traders, we do just want to keep that in the back of our mind. It's not enough of a reason to commit to the market or to make purchases. However, it is something that we do just want to be aware of, that positioning is very light right now, and that will matter when things start to turn and when we do finally get a catalyst to bring us in the other direction. Now, another bright spot this week was the CoreWeave IPO. So this is one of the largest IPOs that we've seen in a very long time. I think coming in around 20 billion market cap, and notably it's really kind of the heartbeat of the AI trade and just where that whole sector and that trend is going. So it's going to be a good sentiment gauge once again, just to track going forward in a very growth sort of important sector in this market. Now, last but not least, Liberation Day. That is, I believe, what they're calling it here. That's next week. That's April 2nd. That's when the rest of the remaining tariffs, which I think the bulk of the tariffs are really going to be clarified and put into effect. And so the market is going to be digesting that, good or bad, above or below expectations. It's going to very likely be a volatile week as markets kind of digest and get used to this new landscape that we are embarking in. So keep an eye on April 2nd. I'm sure the news and media and everywhere else will be talking all about it. Lastly, high yield credit spreads starting to show a little bit of stress this week. And I want to highlight that because it's been pretty subdued, but we're finally starting to get just some cracks there, and it's worth bringing to your attention. Now, before we get into those charts, I want to shout out our sponsor, Investors Business Daily. They actually have a different offering this week. I was talking to the team over there, and they're doing a one-time sort of short selling course, a webinar that is taking place April 2nd. I'm going to put links in the description of this video, but they're trying to be a little more timely here on this to, offer some opportunistic strategies for a bear market or for a volatile market. So check it out. I'll put the link in the description of this video. It's from Investors Business Daily. There's a lot more information about what's included here. And they got a couple of great instructors for this show. So that's that. Let's get into the numbers here. Take a look at this. 1% down pretty much across the board. 2% for the NASDAQ 100. 1 month returns back to very firmly negative territory. We were already in negative territory, but we're now getting deeper into the red after this week's action. You can see volatility was up across the board. The VIX going out above 20. Notably, it is at a lower level than one might expect. Just remember when we sold off to roughly these levels last week, or a week or so ago, we got as high as 28 or high 20s in the VIX, and this time we're more like 22. So a little bit of a less fearful retest, perhaps, one way to look at it, but we're going to look at it in a few different ways. Let's take a look at sectors here. You can see basically one standout, that's Staples, up 1.36%. Everything else was green. Energy tried to hang in there, and it wasn't too bad, but pretty tough across the board. Technology was the hardest hit this week, down 3.54%, and you can see technology over the past 1 month has basically been the worst sector. Now, if we take a look at our sector trends here, we've been talking about how they're just kind of meandering along. It's a lot of messiness here. There's chop, there's uncertainty, and it, after this week, most of those attempts to kind of, make the corner back higher have failed. And we are starting to kind of, again, look at the glass half empty outlook here for many of these sectors. You can see there are lots of confirmed sell signals. There are a bunch of chop, and there's really only energy on the daily time frame that is in a confirmed uptrend. This is our smart trend filter. It's for TradingView. It's also for TC2000, which is the charting platform we're using in this video. So you can check it out on our website if you want to get this, but it really just measures price and volume spanning across time, a couple of price action relationships, and it really aims to kind of smooth out the trend transitions. So that's kind of the messy picture right now. If we move on to market breadth here and take a little bit closer look underneath the hood, you can see that on Friday's session, we did get a flare up in the number of stocks hitting 52-week lows. One of the things we talked about last week was there really just wasn't much to say about 52-week highs and lows. It was just a very subdued reading. There weren't many stocks hitting highs. There weren't many stocks hitting lows. And now that's starting, that landscape is starting to shift a little bit. You're starting to get the number of stocks hitting 52-week lows incrementally moving up again. And so that is now starting to tip its hand back clearly into the seller's favor. Now, I want to bring your attention to this chart here. This is a series of ratio charts. It's a layout we have available on our website as well for TC2000 users, but I really want to bring your attention to this one here, the bottom middle. This is basically tracking high yield credit spreads or risk in the market, stressors in the market from the corporate bond standpoint. And you can see that we're finally now starting to, take a more meaningful leg lower here, just showing that there's some more stress brewing here. And I think it's important to just keep that in mind. This tends to be, when this gets really vertical to the downside here, or when there's real kind of puke levels here, this is when things break typically, right? And there tends to be kind of that clearing event in the market, equity markets, that is. So we're going to want to keep an eye on this. It's not signaling anything too rosy here. This is looking pretty pessimistic going into the weekend, and it's something you can track. We'll track next week. Now, if we take a look here at our macro landscape, you can see the dollar index was basically flat this week, and you can see yields were flat to down depending on what you were looking at in terms of maturity, but you can see it's mostly a holding pattern here. So the 10-year Treasury yield really rolled over nicely on Friday despite hotter inflation data, but it was a big move down on Friday. But you can see it's really just consolidating and could be setting up a nice continuation pattern here lower for yields, lower for the 10-year. And we know that's basically the administration's front center priority right now, is they want 10-year yields lower. They don't really care about the stock market, according to them. Of course they do, but they're focus is on getting this down, and they seem to be doing a pretty good job at that, and it's tough to want to fight it. It looks like this wants to break lower. Now, in terms of commodities, it was a good spot to be this week. Silver, gold continues to absolutely crush. Look at the 1-year returns of gold here. This is just monster moves here, 41% over the past 1 year. You can clearly see where defensive dollars, defensive capital is rotating right now. And it's right to that GLD. Right down the list here, Bitcoin was flat, but we're going to talk about some of the risks in Bitcoin in just a little bit. So that is the big data dump. Let's get into some of the specific price action here. So taking a look here at the S&P 500, that's where we're going to start our analysis. We're going to start on the daily time frame of the S&P 500 and then zoom out afterwards. So if you recall from last week's episode, we were hanging out right into this consolidation right here, right? We went 5 days. We talked about the fact that we compressed last week. It was a compression in range. It was OPEX week. It was a tug of war in between this, call it 5,600 area to 5,700. And we looked at the Friday gap down. We saw the bulls kind of come in and pin it right back to the middle. And we sort of concluded, or our expectation going forward was that there was going to be a push up before a potential move down, right? So the expectation that I sort of set was, 58, a move to 5,800 to 5,850. That was sort of my expectation, and I expected it to be able to play out over the next week or two, right? So we did get the move up. We did get the nice gap and go session here on Monday. Tuesday, we have this little doji kind of consolidation day, and then boom, Wednesday hits, and that is the day where the auto tariffs are now announced and the market sort of remembers, oh yes, this is why we don't want to be invested right now. And the selling basically intensified throughout the rest of the week. So we had a good thing going to start off the week. Markets did not get up to where I expected they could, and we did get sort of a just much quicker move up and then back down. So the way I look at this now is going into next week, I am a lot more pessimistic than I was last week, right? I thought there was a trade to the upside, and I thought that trade could have lasted longer. And the fact that it didn't, the fact that we're back into this range, that we gave up the gap and go move on Monday, we gave up these gains, and we're already pushing back down here, makes me a lot more concerned that there is a more immediate term move coming lower. Now, here's the thing. It's, a balancing act here of volatility and positioning. Like we talked about, sentiment surveys are terrible right now. We know most investors have one foot out the door. Ask yourself, are you in the same shoes? Do you like this market? Do you have 100% long right now? I'd probably say most of you don't. And that is probably the case of a lot of, active momentum tactical traders right now. Hedge funds, they have taken exposures down. And so we just have to be aware of that if the prevailing, sentiment is bearish, this market is just going to have a tough time of just either, potentially going straight down, right? It could be a very choppy road, right? It could be a choppy grind lower, which could be a path that the market takes. So that is a little bit of an aside, but it brings home the point that right now, when we kind of look at where things lie, let's go to this weekly chart. And I think this shows how bearish this week's action resulted, right? We had this compression week last week, wasn't quite an inside week, but it was, pretty close. And we gapped up to start this week. We probed higher, we failed, we reversed, and we totally bearishly engulfed this bar, technically this bar too, the body of it anyway. And so this just looks absolutely abysmal. It is coming again at a pretty important spot where we rejected this 5750 5800 zone, which was some lows here from the S&P, from prior in the year. And it looks about as bad as one could think, right? This looks like sellers are in control. And in fact, it looks like there's potential crash risk here going into the weekend and Monday, just because of the way this is setting up, into a weekend here with basically no bid going in on Friday and just a very headline driven market. So that is the landscape. Technically, I don't think there's anything to like here. I think, when you look at the NASDAQ 100, this looks even worse. Again, tech was the heaviest hit, but we had, again, this 2 days up and then just a sharp drop back down. I mean, the selling on, Wednesday, Thursday weren't coming on heavy volume. The volume, just collectively here on this move back down is lower than this initial move down. So maybe there's something to hang your hat on that it wasn't as intense, but the weekly chart of the Qs look equally as terrible. It was a 4-week down straight line. It was a doji sort of sideways consolidation, and then it just went to immediately selling pressure again. So when I take a look at the technicals here, I don't like anything that I see. We are still in the SPY marginally above the lows here from 2 weeks ago, but it looks like they want to be tested. And that was our expectation, right? When we talk about the analysis that we laid out last week, it was the fact that it did not feel like there was a capitulation event in this market, right? It seemed like these lows were unsettled, and I made it very clear. I thought that we would have to come back down and sort of retest them, or really just kind of convincingly show that those lows can hold. And it seems like we're going to do that already here going into April. So I think for the SPY, for the Qs, risk is on the table here. I think, again, we could chop, we could frustrate, we could carve out a sideways range here longer between 550 and 576 here in the SPY, for instance. But I think that right now things look pretty dangerous and momentum is tipping back to the bears' favor. Now, a couple of things to really keep an open mind here is this bearish engulfing bar. If this is a little micro continuation pattern lower, and if there turns out to be some severe selling that gets followed up next week, then, we can start to look at some measured moves here, and it at least gives us a little bit of a roadmap. But I mean, if we were to make a second leg down like we just saw, so basically this was essentially a high to low of a 10% correction, let's call it. So if we navigated down another 10% from here, that's going to put us right into this spot here, right? And again, it's not a prediction. I'm not saying that we're going there or even in a straight line. I think there's potential, right? There's a probability for all of these outcomes, but just keeping an open mind here that in a very sort of, I guess worst case or the real bear case, if we just see more heavy selling and cascade and this market hates the tariffs and they're ugly fights, and then other countries retaliate very quickly and things just get escalated and out of control, then this is, the roadmap you're looking at, a vertical move back down of a measured move of another 10%. That gets you 20% correction from the highs. First time we've had that in quite some time, going back to 2022. So that's, kind of the bad case scenario, right? The slightly more optimistic scenario is we kind of chug back down here, we retest these lows, we find some support, and then we chop, and we make up our mind further down the road where, after some more time chopping around, right? So for the Qs, if we were to have a measured move in the Qs, that'd be another 13% down. That gets you to basically 425 here, right? That would cause a lot of pain and panic here. Get back down towards the 2021 highs if we do get some measured move like that. So pay attention to, of course, these lows now, the reference point we've got a reference point now of this week's highs, and we can start to think about, if this market can stabilize in this range, then great, we can consolidate, we can chop around, and we can find value and start to look at some individual stocks. But if we just slice through this and find continuation selling next week and we're holding below 468 in the Qs, then really all bets are off. This is not a market you really want to be too heavily exposed to. So that's kind of the outlook there. Definitely a 180 in terms of my analysis and expectations going forward. I think this was a very poor week of price action for equities. If we take a look here at the VIX, I guess there's some solace you could find here that the VIX isn't screaming higher and north of 28 and taking out the old highs here. So it does seem to be a little more relaxed on this, I guess, retest, we'll call it. So maybe that is, a little bit of a saving grace there and speaks to the consolidation that we might see instead of a sharp move lower, but time will tell. If we take a look here at the Treasury yield, so IEF, this is the 10-year Treasury bond, so the inverse of rates. I mean, this got bid pretty nicely here on Friday, and it looks like it wants to go higher, and this means lower yields. So again, I think you see investors flocking and rotating into safety. Bonds acting as a safety haven once again. It certainly wasn't because of the hotter inflation that we got on Friday. I think it was more towards the fact that it is a risk-off market environment right now. And so investors are looking for a little bit of comfort. Speaking of comfort, gold. Gold continues to be the number one spot that's attracting capital from everywhere. Take a look at the year-to-date returns. I'm just going to point it out again, 17%. Last year, it was up 26%. Gold is quickly becoming the best performing stock market there is. And it's just working right now. I can't, with good faith, say it's worth buying up here, but for anybody who owns it or has allocation to it, then you are being rewarded for it. So congrats to the long holders there. This is a core position here in our trend following model, our Galahad trading system. So we've been enjoying the run up here in GLD, and we continue to maintain that position. So gold is working. Let's take a quick look at oil again, because remember that did turn up last week and it did find some more continuation this week as well. So gold, oil, silver, commodities, right? They are working right now in this market environment. These alts are, holding up a heck of a lot better than equities are. Let's talk about Bitcoin as we talk about alternatives here. Bitcoin hanging in there very strong all week until Friday. Friday, we finally saw a little bit of a breakdown here in Bitcoin. It looked like it was going to try and make a run for that 90K level, and then it kind of snapped and broke and started to sell off more aggressively on Friday along with equities. So Bitcoin is back in the penalty box for me. So our trend model has been out of this now for quite some time. But if you recall, a couple weekends ago or a couple of videos ago, I did some dip buying. This was one of the initial dip buying places I was doing on that immediate leg down in the equities market. I was fishing for some Bitcoin, and I ended up selling all of that on the open today on Friday. So right at the open, a decent trade. I thought it could go up to the low to mid 50s, didn't quite get there. So I'm out of that trade. I'm basically out of all the dip buys that I made on that initial leg lower here, right? When the SPY was kind of cascading down in this area, I was doing a little bit of buying in some various things, and I am out of all of that now, and I'm just reassessing flat, cash heavy, and waiting for potentially this next shoe to drop before going bargain hunting again. So Bitcoin, I think there's risk again. I think risk is opening back up towards these lows. Going sub 80K would be, really speaking to another kind of leg lower here in Bitcoin, and I think the probabilities of that are starting to rise for that second leg lower. So that is kind of all the majors I wanted to talk about. I think, when we look, let's just go to the Mag 7 here. You can see that this continues to be a painful spot to be. You can see Google with fresh breakdowns this week, Meta rolling back over. Microsoft was starting to look okay as it was trying to reclaim this lower end of the range, and then that just kind of broke lower. And most of these Mag 7 stocks look pretty terrible. Tesla kind of trading in its own universe right now, given some of the auto tariffs, some of Elon's association with the administration. And so this is kind of in its own little world. But, obviously there's really not too much that's pretty here in terms of Mag 7 stocks. I do say, and I'll reiterate again, I think this is the time, especially for you longer term investors, position traders, to sharpen the shopping list, right? To really start doing the homework and curating the things that you want to own at the prices you want to own them at, because you never know if we do get this cascading event, if we do get a sharp leg lower here in the next week or two, you want to just be prepared mentally and with an action plan to start, deploying capital if you are a longer term kind of value, looking for that value, looking for buying the panic, right? That's personally what I'm doing. I've got the shopping list ready. Maybe I'll do a separate video of the things that I'm looking at, but I don't really it's besides the point. I think ultimately it's just, you got to figure out what you want to own. If it's the SPY or the Qs, then that's totally fine. Or if it's the Mag 7, then, you can start to just get that ready. Again, you can always DCA in as we continue to sell off as well. It's always a good strategy, kind of reduces stress and keeps you even keeled as you start to get more and more, kind of oversold and cheaper prices. For you tactical traders that are trading momentum, it's a whole different ball game, right? You're really, again, you're looking, if you're a short-term opportunistic sort of day trader, short-term swing trader, then, you're looking at these lows here and you're looking to play the gamma move down, the flush, the breakdown, right? If if these lows don't hold, then you're really pushing for this leg lower here. You're shorting, you're looking for those, those vulnerabilities to play the market on another swing lower. So it's, again, time frame matters here, and risk tolerance and strategy and all that fun stuff. So that's it. That's what I got. I think it's a difficult, choppy environment right now. I think the most positive thing is that sentiment is so terrible, but that alone is not a reason to buy. I think there are risks. They've opened up. The market could not sustain higher prices. They rejected spectacularly, and now we're going to brace for a more volatile week ahead. So that's what I got. Hopefully everybody managed it okay. Hopefully you're able to capture maybe the quick profits from the start of the week and not give them all back. But if you did, that's fine. Just get, learn from it and craft that plan going forward. So that's it from me. Thanks as always for tuning in. Don't forget IBD. We got that sponsor spot here with their short selling webinar. Going to put a link in the description of this video. And for any of you who are looking for trading strategies for this market environment, check out what we have available at thetraderisk.com. So that's it for me. Take care. Have a great weekend. We'll see you back here next weekend.